Welcome to another property finance video by Axial Capital Partners. And this time we're going to look at an important piece of any property development, and one that's not an uncommon sticking point for a lot of developers that we raise funding for, and that is the cash flow for the development itself. So this video looks at the elements to be considered when creating a cash flow and the format to use when laying out the requirement for and the use of those funds. And in this example, we're going to use a development for a housing scheme that we raise the acquisition and build capital for. And it's large enough to illustrate some common costing considerations that a developer will face when creating a full appraisal. Effectively, planning a development cash flow isn't solely to do with numbers. It's about thinking of the design and build and how it'll be managed and executed through the build program. So the numbers can be laid out both vertically and then spread month by month across the build program. So that's what we're going to look at further in this video. So firstly, as mentioned, this is a project we raised the money for. It's 25 bungalows. The site had planning, fairly straightforward to get in and start. So then we look at costing the core elements of the overall development. Now that starts for any developer with the design, the planning phase. There can often be a number of costs in there, and that needs to be considered. You'll then think about what your build method is going to be, what your structure is going to be made from, and you'll cost that in a broken down fashion. Then, of course, the land itself, from surveys through to preparation, through to footings, costing every element of that. And finally, you'll think about the spec, the finish of your properties, and costing it accordingly. So once you've done that, you can collate the numbers into a single development cash flow. And that's what we'll look at now. So in this particular template, we have started by laying out the build program or the overall schedule across the top of the spreadsheet. We then show within there the sales profile, or generally how the revenue is going to look from this particular project. Now that comprises both the number of units and the values to be attributed to the types of units. I say types because you may have flats and houses in the same development, for example. It may also be commercial, and as there was in our case, and affordable as well. Breaking the costing down, we will do that again on a per type of unit basis. As we said, with this project, we had one affordable that went out for a nominal £1. You may also, if you're building a block of flats, consider ground rent as a freehold will also have a value which you can attribute to your final GDV. So when we break down the sales profile over the total project schedule, we can start by entering the number of units that we know we should be showing in the total sales. In this case, the yellow boxes are our manual entry boxes. So here we can see that we are missing 5 units. So if we estimate that by month 11, we're going to start seeing sales materializing, I can enter that, and our reconciliation, my check, now shows that I've entered my month-by-month sales at the right figures. We then attribute a sales value, in this case an average sales value, to each of the 24 units. We're going to say 250,000 for each of these, and that then shows, according to our sales profile, month-by-month revenue figures, so we can see when money is going to be coming in. Ultimately, that gives us our single exit or GDV. As we move down the cash flow, we then have to consider the costs to complete the development to achieve that GDV. In this case, we've broken this spreadsheet or this cash flow down into direct construction costs and our land and general development costs. You might consider preliminaries. You may also consider, if you're building a block of flats, a basement element. That could be costed separately because you may have a specialist subcontractor to quote on that. Again, this is not exhaustive, but these are the sorts of things that you can consider when putting your cash flow together. Under our land and general development costs, of course, we show the land and the relevant acquisition costs. This might be legals, for example. You'll also consider issues such as your council levy or your Section 106. In our case, we had a £40,000 consideration. You'll also consider your various professionals and break those down into individual costs, because those costs can come in at different stages throughout the build. Now again, our vertical costing, which we mentioned before, that goes into our reconciliation or check column. We enter this manually before we start breaking that cost down over the month-by-month funds utilization. So ultimately, we want to see that our vertical costing and our month-by-month costing reconciles. So if we start with our construction costs, again, we can see that we have allowed or budgeted for $175,000 of preliminaries. We now break that down to how much we expect to use on a month-by-month basis. Again, utilities, services, they're going to come early on when we start our infrastructure preparations, when we engage with the utilities providers. And what we want to see is that our numbers here reconcile. If they don't, then clearly we haven't allowed for the full expenditure. Now we've pre-populated this so we can see that the rest of our numbers reconcile. And again, that's why we have our check column, to make sure that we haven't missed anything. Now here we show the month-by-month total. That is the running total. And in this case, we've also allowed for contingency, which essentially you should in every cash flow. We also have our cumulative or our running total throughout the project. Considering our land and development costs, obviously in month one, we're going to deploy the full land purchase costs. Again, you may have delayed exchange or option agreements to consider, but for simplicity, we have a single acquisition cost. We know that in this particular project, our Section 106 payment was due in month 3. So we'll enter that here, and we should see at the very bottom our numbers now reconcile as we pre-populated the rest of this section of the cash flow. And that's good, our numbers do reconcile. We know that we've budgeted for and allocated month by month the total amount for each line of our cash flow. Now in this case, we've also factored in and allowed for finance costs. You don't necessarily have to do that to this much detail, but this just shows you can add essentially everything you want into the cash flow to make it as detailed and as thorough as you choose to do. In this case, we've shown our monthly interest costs as it applies to the month-by-month drawings or deployment of the funds. We've allowed here for the arrangement and the exit fee as well, just to make sure that we haven't missed any costs. So we've now entered all of our development costs, our construction costs, and our finance costs, and we come to the grand total, which we've broken down, a sum total including finance, but we also want to consider how those numbers come together and how those numbers break down. Which is why directly underneath, we allow for a total direct costing figure exclusive of finance. That tells me how much the project itself is going to cost. Now, once we have those numbers, that allows us to determine our overall gross profit. So this is our pre-interest, our pre-finance gross profit. So we've looked at our total GDV, total sales value, less our construction costs, less our acquisition and development costs. And that gives us our gross profit without considering finance. Now, through the month-by-month usage of funds, we can see in the red where we have a negative flow of cash until we are back in the black, essentially, where we're starting to show positive cash flows again. And it's based on that, X finance, our direct profit on cost, our direct profit margin. And in this case, we were running at just under or just over 28%. We then take the next line down, essentially the same thing again, but this time we've allowed for the interest costs. So it gives us our true net profit, our bottom line after paying out interest costs. And again, we have a reconciliation there, our check that shows that we have deployed the right numbers. And there we can see that we have a profit on cost at the bottom line of just under 22%. So again, in summary, we've laid this out by spreading the cash flow over the entire development program, development schedule. We want to be clear on how many units we're going to be selling and when those sales are going to occur, attribute a value to each of those sales, and by doing so, we can see our overall GDV. And then we want to break our costing down into a relative amount of detail, which helps us to see where the money's going and potentially where savings can be made. That's always a key consideration with your cash flow as well. But personally, it is about month by month when you're going to need money. Now that's relevant, especially when you're using finance. You need the financier to know month by month how much money has to be made available. That then flows into the finance costs that will be relevant on that month-by-month expenditure, and that will ultimately give you your total costs, your gross profit, and your running negative and ultimately positive cash flow figures. And the same on the bottom line. But this time it's taking out the finance element and showing you your ultimate net profit. So to summarize this particular example, we took a development of 25 new build houses. In this case, it was a blended finance and equity profit share model. It was backed by a joint venture partner of ours. And we've costed from the design, the planning phase, all the way through to the build, the finish, and ultimately the sales. So we took the approach of vertically costing and then spreading that cost over a month-by-month build schedule. If you'd like to discuss any property finance or joint ventures, we welcome you to make contact with us, and we'll gladly talk it through with you at Axial Capital Partners.